Welcome to our deep dive into the world of hedge funds. Today we're exploring the crucial question: is investing in hedge funds truly worth the risk? Hedge funds have long been shrouded in mystery, often associated with high returns and equally high risks. But what exactly are hedge funds, and why do they attract both seasoned investors and those seeking to diversify their portfolios? In this video, we'll break down the basics, examine the risks and rewards, and help you decide if hedge funds fit your investment strategy. Let's start by understanding what sets hedge funds apart from other investment vehicles. Hedge fund is a pooled investment fund that employs diverse strategies to earn active returns for its investors. Unlike mutual funds, hedge funds are less regulated and often use leverage, derivatives, and short selling to maximize gains. They're typically open to accredited investors due to their complex nature and higher risk profile. Hedge funds aim to generate positive returns regardless of market direction, making them attractive during volatile time. However, their strategies can be opaque, and understanding their inner workings is essential before investing. Let's look at how hedge funds operate and why they're considered unique in the financial world. Hedge funds operate by pooling capital from investors and deploying it across a variety of assets, including stocks, bonds, currencies, and alternative investments. Fund managers use sophisticated strategies such as long-short equity, global macro, and event-driven approaches to seek returns. Unlike traditional funds, hedge funds often have more flexibility in their investment choices and can quickly adapt to changing market conditions. This flexibility is a double-edged sword, offering the potential for outsized gains but also exposing investors to significant risks. Understanding these operations is key to evaluating whether hedge funds align with your risk tolerance. Hedge funds employ a wide range of strategies to achieve their goals. Some focus on long-short equity, betting on both rising and falling stocks. Others use global macro strategies, making big-picture bets on economic trends across countries and markets. Event-driven funds capitalize on corporate events like mergers or bankruptcies. Each strategy carries its own risk and reward profile, and fund managers often blend multiple approaches to diversify. Understanding these strategies can help you assess which funds might suit your investment objectives and risk appetite. Hedge funds are typically reserved for accredited investors, such as high-net-worth individuals, institutional investors, and family offices. These investors are presumed to have the financial sophistication and resources to understand and withstand the risks involved. The high minimum investment thresholds and complex strategies make hedge funds less accessible to the average retail investor. However, for those who qualify, hedge funds offer the potential for portfolio diversification and access to unique investment opportunities not found in traditional markets. One of the main attractions of hedge funds is their potential for high returns. By employing advanced strategies and leveraging market inefficiencies, hedge funds can outperform traditional investments, especially during periods of market volatility. Some funds have delivered impressive gains, making headlines and attracting more investors. However, it's important to remember that past performance does not guarantee future results. The potential for reward comes with significant risk, and not all hedge funds achieve their ambitious targets. While hedge funds offer the allure of high rewards, they also come with substantial risks. These include market risk, liquidity risk, and operational risk. Because hedge funds often use leverage and complex derivatives, losses can be magnified. Additionally, some strategies may not perform well in certain market conditions, leading to significant drawdowns. It's crucial for investors to thoroughly understand these risks before committing capital to a hedge fund. Leverage is a key tool used by many hedge funds to amplify returns. By borrowing capital, funds can increase their exposure to various assets. While this can lead to higher profits, it also increases the potential for losses. In extreme cases, excessive leverage has led to the collapse of entire funds. Investors should be aware of how much leverage a fund uses and consider whether they are comfortable with the associated risks. Liquidity refers to how easily an investment can be converted to cash. Many hedge funds have lockup periods, meaning investors cannot withdraw their money for months or even years. This lack of liquidity can be problematic if you need access to your funds quickly. It's important to understand the liquidity terms of any hedge fund before investing, as this can impact your overall financial flexibility. Hedge funds are known for their lack of transparency compared to mutual funds or ETFs. They are not required to disclose their holdings or strategies in detail, which can make it difficult for investors to fully understand what they're investing in. This opacity can increase the risk of unpleasant surprises, especially during market downturns. Always ask questions and seek as much information as possible before investing. Hedge funds typically charge higher fees than traditional investment funds. The common structure is known as 2 and 20, a 2% management fee on assets and a 20% performance fee on profits. These fees can significantly eat into returns, especially if the fund underperforms. It's essential to understand the fee structure and calculate how much you'll actually keep after fees before deciding to invest. Hedge funds operate with less regulatory oversight than mutual funds or pension funds. This allows for greater flexibility, but also increases the risk of mismanagement or fraud. Regulatory bodies are working to increase transparency and protect investors, but it's still important to conduct thorough due diligence. Understanding the regulatory environment can help you make more informed investment decisions. Historically, some hedge funds have delivered outstanding returns, especially during market downturns. However, many funds have also underperformed or even failed. The performance of hedge funds varies widely, and it's important to look beyond headline numbers. Consider the fund's track record, risk-adjusted returns, and consistency over time before making a decision. Let's look at a real-world example of hedge fund success. During the 2008 financial crisis, some hedge funds used short selling and other strategies to generate positive returns while the broader market plummeted. These funds demonstrated the potential for hedge funds to protect capital and even profit during turbulent times. However, such success stories are not the norm, and many funds struggled during the same period. On the flip side, there have been notable hedge fund failures. Some funds took on excessive risk, used too much leverage, or failed to adapt to changing markets. These failures highlight the importance of risk management and due diligence. Investors should always be cautious and avoid putting all their eggs in one basket, no matter how promising a fund may seem. One of the key benefits of hedge funds is diversification. By investing in assets and strategies that differ from traditional stocks and bonds, hedge funds can reduce overall portfolio risk. This diversification can help smooth returns and protect against market downturns. However, it's important to remember that diversification does not eliminate risk entirely. For investing in any hedge fund, thorough due diligence is essential. This means researching the fund's strategy, management team, track record, and fee structure. Ask for references, read performance reports, and understand the risks involved. Taking the time to do your homework can help you avoid costly mistakes and choose funds that align with your goals. Success of a hedge fund often hinges on the skill and experience of its manager. A talented manager can navigate complex markets and adapt strategies as needed. When evaluating a fund, consider the manager's background, investment philosophy, and history of performance. A strong manager can make a significant difference in your investment outcome. Hedge funds provide offering documents that outline their strategies, risks, and terms. It's crucial to read these documents carefully and ask questions about anything you don't understand. Pay attention to the fund's investment approach, redemption policies, and fee structure. Clear understanding of these documents can help you avoid surprises down the road. Investing in hedge funds can have complex tax implications. Depending on the fund's structure and your location, you may face different tax rates on income, capital gains, and distributions. It's wise to consult with a tax advisor before investing to understand how hedge fund investments will impact your overall tax situation. Hedge funds and mutual funds may seem similar, but they differ in key ways. Hedge funds are less regulated, use more complex strategies, and are open only to accredited investors. Mutual funds are more transparent, accessible, and typically have lower fees. Understanding these differences can help you decide which investment vehicle is right for you. Hedge funds usually require a high minimum investment, often starting at $1 million or more. This high barrier to entry limits access to wealthy individuals and institutions. If you're considering hedge funds, make sure you're comfortable with the minimum commitment and the potential impact on your overall portfolio. Redemption policies dictate how and when you can withdraw your investment from a hedge fund. Some funds allow quarterly or annual redemptions while others have longer lockup periods. Understanding these policies is crucial as they affect your ability to access your money when needed. Always review redemption terms before investing. Hedge funds typically provide less frequent and less detailed reporting than mutual funds. This can make it harder for investors to track performance and understand what's happening with their money. Before investing, ask about the fund's communication practices and how often you'll receive updates. There are many myths surrounding hedge funds, such as the belief that they always deliver high returns or are only for the ultra-wealthy. In reality, hedge funds vary widely in performance and not all are closed to smaller investors. It's important to separate fact from fiction and base your decisions on research, not rumors. Hedge funds operate globally with major centers in the United States, Europe, and Asia. Each region has its own regulatory environment and market dynamics. Understanding the global landscape can help you identify opportunities and risks unique to different markets. Technology plays a growing role in hedge fund strategies. From algorithmic trading to big data analysis, funds are leveraging technology to gain an edge. This can lead to faster decision-making and more sophisticated strategies, but also introduces new risks such as cybersecurity threats. Some hedge funds invest in controversial sectors or use aggressive tactics that raise ethical questions. As an investor, it's important to consider whether a fund's strategies align with your values. Review the fund's investment policy and ask about their approach to responsible investing. So, is investing in hedge funds worth it? The answer depends on your financial goals, risk tolerance, and investment knowledge. Hedge funds can offer high rewards, but they come with significant risks and complexities. Carefully weigh the pros and cons and consider consulting with a financial advisor before making a decision. Conclusion: hedge funds are complex investment vehicles that offer both significant risks and potential rewards. They're best suited for sophisticated investors who understand the nuances of alternative investments. If you're considering hedge funds, do your homework, ask questions, and make sure they fit your overall financial plan. Thanks for joining us on the exploration of hedge fund risk versus reward. Stay informed and invest wisely.